everybody. It's great to see you all here at this year's VRIC. Gold touching $5,000, silver in the triple digits. It is truly an exceptional time right now for precious metals. So I'm very excited to be sitting here with Ronnie discussing it today. So the first question I want to tackle is this bull market that we're seeing at this point, because it surprised a lot of people, including bulls in both gold and silver, particularly to see silver run so far, so fast, and gold now approaching $5,000 an ounce. How are you viewing that move? Is that something that concerns you in terms of how quickly it moved up and that we could see corrections ahead? Or do you think we've entered a completely new era for precious metals?
No, I mean, let's face it, there's going to be a correction. And to be honest, I thought in October when we had this massive 5.4% drawdown in gold, I thought, okay, this is now the time that we are taking the breather. But then actually we went back above 4,000 very, very quickly. So this shows me that there's just so much interest waiting on the sidelines. People are just desperately waiting to get into the gold trade. And this is primarily Western financial investors. So when I'm talking to institutional players, other funds, they say, well, we didn't have an allocation to gold, we missed the train, and it's just relentlessly rising, and every minor dip is being bought. But let's face it, I mean, last year gold was up 56%. This year it's already up, like 12, 13%. At some point there is going to be a correction. It's like running up a hill. At some point you have to, take a breather. I think it's going to happen at some point. Actually, I said it in a previous interview. The markets want to see the big round numbers, and it's the 5,000 in gold, but also the 100 in silver. This is like what the market wanted to see. But I think we'll see over the next couple of weeks. We see the start of a correction. So we've been pretty cautious, perhaps too cautious. We took some chips off the table. We had some hedges in, and I feel very comfortable. We didn't hit the brakes, but we took our feet off the gas pedal, basically.
Well, you mentioned institutional investment in the space. We have seen big money start to embrace gold more. Perhaps the most recent prominent example is the CIO of Morgan Stanley recommending 20% gold allocation along with bonds and stocks, kind of a difference in the original 60-40 portfolio. Are we going to see more institutions move in that direction? And how much of an impact do you think that could have in terms of institutional buying in the gold sector?
Yeah, that's the next stage of this bull market. I think that, I said that previously on the panel, in the Western world, we tend to forget that the majority of gold demand is now coming from emerging markets. So actually, the gold market couldn't care less about what's going on in Canada, in the US, in Switzerland, whatever. The demand and the growth in demand is coming from China, from India, from the Arabic world, from Turkey. This is 75% of physical gold demand now. They do have much more gold culture than we have, probably because also those are kind of low trust societies, and this is something that's also happening to the Western world. We talked about Serbia before. So I think people are losing trust in government, in politics, in societies, in science, in the media. And, gold has built up such an enormous amount of trust capital over the last 5,000 years that this is some sort of a natural trend towards gold. So the foundation of this bull market is coming from emerging markets. We described that in our 2024 in Gold We Trust report, saying this is the new gold playbook. And Asians tend to buy the physical stuff. They don't want to buy futures, they don't buy mining stocks, they don't buy ETFs. Then 2022, obviously, there's this other big driver was coming in, which was central bank demand. 4 years in a row, more than 1,000 tons of gold being purchased by central banks. That's roughly 1/3 of annual gold production. This is another powerful driver. And now, very late, not very late in the game, yeah, but definitely not early on, Western financial investors started buying gold. And you could see that from gold ETFs, for example. They were like, starting last year, there was like ETF flows finally coming back. And I think this is really going to be going forward, probably one of the most important numbers to follow. So where is the ETF demand developing? This is for us a proxy for Western financial investors. And there was a study by Goldman. So on average, their large clients above 100 million, they own 0.17% gold. So I would say it's not really a bubble. Then there was a study by UBS in 2024 where they asked family offices, what's your allocation to gold and precious metals in general? Less than 2%. Commodities, less than 1%. And I can tell you from my daily experience, there's lots of institutional players like small Swiss pension funds calling us and say, well, actually, we're considering selling some gold. You know, gold price has risen so much. We're now having 3% allocation to gold. It's too much for us. Yeah, we cannot stand the volatility anymore. So we're reducing our risk in gold back to 2%. So therefore, I would say we're in a bull market. We're not in a bubble. And I think that Western institutional demand is really going to be the major driver. And this brings me back to the 60-40 portfolio. Obviously, why did the 60-40 portfolio work? Because inflation wasn't a concern at all. Now it is, starting in 2022, you can tell that the 60-40 portfolio doesn't work anymore. And this is why we created the so-called new 60-40 portfolio, which works perfectly well in real time. Yeah, so there's like a 25% alpha to the traditional 60-40 portfolio. And I think this is really the future demand, 160 trillion being allocated in fixed income. I think this is where the future demand from institutional players for gold is going to come.
You mentioned the emerging markets there and how they're a big driver behind the gold market at present. A lot of those cultures view gold as money, unlike here in the West. I'd love to get your thoughts on gold's potential return to the monetary system. It feels like it's being viewed more and more as a monetary asset by the market at large. Are you seeing that shift? And there's a lot of hyperbole around this topic and a lot of different narratives out there. You know, the BRICS are going to start trading using gold or a gold-backed currency. There could be 50-year U.S. gold-backed bonds. Basel III has come into effect now. Maybe you could walk us through what you're seeing out there when it comes to the monetary landscape for gold and how it's shifting.
I mean, that's really the most crucial question for us now, being in the gold camp. Yeah, are we like in the middle of a remonetization of gold, some sort of a Bretton Woods moment? And you know, 1 or 2 years ago, that sounded like a crazy theory that is being discussed in the gold bug community. But now Scott Bessent is saying he wants to be a part of a Bretton Woods moment. We've got Judy Shelton saying that for the 250th birthday of the United States, they should be issuing gold-backed 50-year or century bonds. Donald Trump, his first words at the inauguration was "Welcome to the Golden Age." So I think gold has been like on the very small niche stage, and now it's finally on the center stage. Yeah. The ECB is getting nervous because gold took over from the euro as the second largest reserve currency. So I would say, if we're really talking about a revaluation or remonetization of gold, then gold is still cheap. So gold is expensive versus commodities versus oil especially. Yeah, it's not a really contrarian trade anymore. But if you value it as money, and if you have the shadow gold price, for example, so saying like if 25%, 40%, or even 100% of the monetary base would be backed by gold, then for 25%, the price of gold would have to be 5,600. For 40%, 8,500. And for 100%, roughly, I think slightly above 20,000. Now, 20,000 gold, it sounds outlandish, but then on the other hand, we had every 40 years, we had it in the end of the 1930s, beginning of the 1940s, but also in 1980, the US monetary base was backed by more than 100% of gold. So we had it previously. I cannot rule it out that we'll see it again. And with all those developments, seeing, you know, central banks buying like crazy, the BRICS becoming much, much more self-confident, I think we're like basically this is it, yeah. And we once had an interview with the legendary blogger Fofo, a friend of another. He's kind of a very mysterious blogger with a central banking background, and he said, I'll never forget it. He said, you only need one gold revaluation in your lifetime. If you play that right, basically that's generational wealth.
Well, let's home in on silver for a moment and what the differing factors are that are driving silver versus gold. Obviously, very exciting times for silver stackers. I've known perhaps not a less religious group in the investment world in terms of their passion for that particular asset category. What would you say are the main drivers behind silver right now? And it's gone on a parabolic run at the moment. So in similar line to my question about a correction in gold, do you think we could fall on the other side as rapidly as we did in the previous two peaks, 2011 and 1980, where gold kind of rapidly came down on the other side? Could that be a risk as well?
I don't really see it happening. First of all, I think that the drivers on the demand side are fundamentally different. We've seen like 5 years in a row with massive supply deficits. We're now finally seeing that investors' demand is kicking in, and we all know that silver is a pretty small niche play, and if there's like really money being funneled into that small market, it can really move the silver price significantly. And we always said, like, that was the leitmotif of last year's report, the big long, and that's like, it was quite a big report, yeah, and we're already working on the next report. So the 20th anniversary of In Gold We Trust will be published on May 20th. But we said last year, and we crunched the numbers on that gold always goes first. So it's like in cycling, yeah, where you're having at some point out of the draft, there's silver coming and then commodities. And this exactly played out. So in the second half of a gold bull market, silver usually tends to outperform gold. So from my point of view now with the gold-silver ratio, of course, I mean, it's not that extreme anymore, like it was above 100. Back then it was, in hindsight, it was easy to be super bullish on silver. But I think if you have a look at previous, the final stage of gold bull markets, the gold-silver ratio usually is at around 15 to 20. So I've got one slide for my upcoming presentation where I'm showing like various gold-silver ratios and where would silver be at certain gold prices. And we said in the year 2020, in Gold We Trust report back then, we said our conservative price target for the end of this bull market is 4,800. We actually already achieved that. Back then, people said, you guys are crazy. And then we said if there's an inflationary scenario as well, then this is $8,900 US price target by the end of this decade. So 8,900 still sounds pretty bullish, I would say. But then from here until 2030, that's a 12.4% CAGR, which is, I think that's pretty realistic. Now, if gold goes to 8,900 and the gold-silver ratio goes back to 20, 15, or even 10, I think that's pretty simple math. So there's still way to go. And again, I think that investors' demand for silver, it only kicked in quite recently, but that's not a big trend yet.
Let's talk about the gold mining sector for a moment now, because for much of last year, it wasn't really providing that levered play on the price of gold itself, but then it began to outperform. A lot of the gold stocks now doing extraordinarily well. Where are you currently seeing value in the sector? Do you think the big producers are still undervalued at these levels, or would you be looking more to the developers and the explorers to find the value at this point?
Actually, I think that gold mining stocks, the large caps, are actually value plays now. I was at a birthday party and I wanted to stay. My wife said, let's leave around midnight. And there was a guy coming up and said, yeah, you're this gold guy, yeah? You're writing those big reports on gold. And I said, yes, that's me, I'm sorry. And he said, well, actually, my portfolio is full with, Franco and Silver Wheaton, and I own Newmont and Agnico. And I said, so you're running a gold mining fund? And he said, no, I'm running a deep value fund. And I thought that's really interesting. And he said, there's just so much value on the balance sheet gold mining companies at the moment. So I think it's really, we're definitely not super cheap anymore, but I don't see any overvaluation in the large cap space. We're still seeing the majority of the companies having long-term gold targets that you're calculating with around 3,000. Nobody has like 5,000 in their long-term plans. We haven't really seen a big M&A wave yet. I think most of the deals that were announced totally made sense, and you could tell that from actually the performance afterwards. And I think, in the junior space, we'll see, like in every big trend, we'll see like crazy M&A. But for the time being, I think that the gold mining industry is probably at its healthiest stage that I've ever seen it. Companies talking about, buying back shares, increasing the dividends. Although I have to say, I know very, very few investors that actually buy gold mining stocks because of their dividends. But I think, going forward, if those price scenarios are playing out as we think, I think it's still a great entry point.
I'd love to get your thoughts, too, on the question of Fed independence and how central banks are playing a role in affecting the gold market with how they set interest rate policy. Because obviously we've seen some interesting things develop recently. Jerome Powell now under criminal investigation by the Trump administration. Trump likely to install a Fed chair who is going to be willing to follow his directions on lowering interest rates. I wonder what your thoughts are on that whole scenario, the death of even the illusion of Fed independence, it feels like, and how a lower interest rate environment could potentially affect the precious metals markets.
Well, I don't know who really believes in Fed independence. I mean, that's and I think that what we've seen recently that definitely adds to my thesis of the U.S. becoming a low trust society, and long-term partnerships and relationships are suddenly being questioned. And this was only the first year of Donald Trump. What to expect in the next 3 years? But that definitely helps gold. But then on the other hand, I think that my friend Brent Johnson sitting there, he's like, you probably don't agree, but so far we haven't seen any major development in the US dollar. So if that's a big if we're moving into a big bear market in the US dollar, and I think if you just look at the Dixie, it's obviously that the enormous weakness in the Japanese yen that makes the US dollar look a little bit stronger. But if you believe that a big bear market in the US dollar is ahead, that would be an additional driver for the price of gold, obviously. Now, we always have this table with the price of gold in various currencies. And obviously last year gold was doing much better in US dollar terms than in euro terms. But then what I find fascinating is that actually in the last 25 years, the average annual performance in most of the major fiat currencies was between 10 to 12%. So, they're all devaluing versus gold. And therefore I think, do I believe in the euro? Will the euro be around in 20 years? I'm not sure. I don't think so. If it still will be around, what will be the purchasing power of a euro? What's a beer gonna cost, or a meal? So therefore, I think it's just a long devaluation process that we're in. I think it's interesting that Wall Street finally, a couple of months ago, picked up the term debasement trade. I think this is going on for a little bit longer already. But I think, obviously, this whole show around Jay Powell, I thought it was embarrassing. Yeah, I felt sorry for Jay Powell, and I'm not the biggest fan of Jay Powell. But obviously, it doesn't really add to the credibility, and this improves this or strengthens this loss of trust that we're seeing in the U.S.
Well, some great thoughts from you today, Ronnie. Could you tell people where your next speaking engagement is happening and what time it is so people can come watch it?
I think it's 1:30 over there, 1:30 or 1:20. Talking about my thesis for gold, why gold is still vastly underowned, what I like best. And yeah.
Great. Well, please do attend Ronnie's next talk. And a warm round of applause, please, for Ronnie Stoefferle. Thank you all so much.